inflation-adjusted bond yields. It's kind of a mouthful. Let's dive into this topic and really help educate the viewers on what this is and why it even matters, and how they can use this information, because we're seeing something we haven't seen since probably the 70s.
So the first thing, the dark blue line on this chart, is just the yield to maturity on the 10-year Treasury note. And you can see we've put a dashed light blue line there to show that yields on 10-year Treasury notes have been on a downward trajectory since the 80s. They peaked out in the 80s at about 15% back when some folks may remember you would get a mortgage at like 20%, crazy to even think about now. And right now, the yield on the 10-year Treasury note is about 1.6%. So that yield is really your starting point for investors to determine how attractive buying a 10-year Treasury note is, or effectively lending the U.S. government your money for 10 years. And it's not very attractive. But you also have to think, if you're going to lend your money to the government for 10 years, how much is the purchasing power of that money going to be eroded over time due to inflation? And so you subtract out the core CPI, core consumer price index, which right now is running at about 4%. And what you get is an inflation-adjusted bond yield, 10-year Treasury note yield minus core CPI reading, of negative 2.5%. Extremely unattractive. So you'd say, I lend the US government my money for 10 years on a nominal basis. Before inflation, I make next to nothing. And then after inflation, I am most likely going to lose quite a bit of money.
So to say it more simply, I lend the government my money. I get a very small coupon back, and over that 10-year period, the price of everything I have to buy goes up so much more than the money I'm making that I actually am less wealthy at the end of the exercise.
Exactly right. Yeah, very well put. And we're sharing this chart with clients quite a bit now, because you think about investors, if on a very high level, have a binary decision to make. Am I going to own equities or risk assets, or am I going to own safe assets, things like cash and high quality bonds? And one of the best things that risk assets like equities and stocks have going for them is they're not high quality bonds, because bond yields are so incredibly unattractive. And this reinforces what we've been talking about for quite some time, has been a theme all year in the outlook, the TINA effect. There is no alternative to equities. You can say equities are expensive. You can say there are certainly economic risks on the horizon, things like supply chains, inflation, a tightening Fed, so on and so forth. But the fact of the matter is, even if you were to talk yourself out of owning equities, you would have to talk yourself into owning something like cash or high quality bonds, where you get next to nothing, and then after inflation, you lose money.
Right. So that's a great question to address here. So let's say I'm looking at this chart. There's two decision points here. The first is the yield I'm getting, which is awful, historic lows. The second is I'm going to lose buying power. So the first question I would ask is, why would I ever? Who would invest in these bonds or in any bonds?
Yeah, and the answer is the Fed. The Fed's still buying a lot of these bonds. The other answer is foreign buyers have stepped back in. So you look at a 1.6% yield on a 10-year Treasury note. That seems very low and unattractive. But if you're a Taiwanese life insurance company, or you're in Japan, where Japanese government bond yields are zero and have been zero for a long time, this actually looks very attractive to you. So those folks are buying it. And then, of course, you may not be making any money by buying 10-year Treasury notes, but it's some of the most pristine collateral that all global financial institutions want. So there's always going to be demand for U.S. Treasuries, just because they are collateral for other financial transactions that you could engage in, where you actually could make money.
Yeah, I'm going to knock on wood for that one. Anyway, so the next question would be, well, if these bonds if they're being impacted by inflation so much, doesn't inflation drive bond yields higher? And when does that happen, and what does that do?
Yeah, typically that's the case. So if you go back to the last time the green line was this low, which was the 80s, what you saw was how this sort of rectified itself was the blue line shot up. So interest rates shot up dramatically to price in higher inflation. And there's an aspect of that happening, but on a far less of a magnitude than we saw back in the 80s. So we think inflation will put upward pressure on the blue line on nominal yields, but you also have to take into account how much debt there is in the global economy. Because at the end of the day, the US government cannot afford to have the 10-year Treasury yield be above 2.5%, 3%. The math just doesn't make sense when you think, how are we going to finance this fiscal deficit? And central banks, therefore, have to play a much bigger role in monetizing the debt. So they're effectively going to put a lid on that blue line, keep it from going up too quickly and too much. It could drift higher because of inflation, but we cannot afford 15% a yield on the 10-year Treasury note. The math just does not make sense given the fiscal deficit.
Okay, a couple more questions here. First one would be, what is a tip, and should I invest, or should the viewers invest in tips to sort of looking at this situation? Is this better than buying an actual bond?
So a tip is a Treasury inflation protected bond or Treasury inflation protected security. And basically what that does is you lend your money to the government for 10 years, and then your coupon payments that the government pays you effectively grow with CPI. And so you could say, well, that seems attractive if inflation is going to be high over the next 10 years. But the market has already priced in expectations for what inflation over the next 10 years are going to be. So really, if you're thinking, well, should I buy the nominal Treasury bond, the 1.6% yielding 10-year Treasury note, or should I buy a tip? Really, the bet you're making is, do I think inflation is going to run hotter than what everybody in financial markets already expects? Then it would make sense to own a tip. And so this year it has made sense to own tips because inflation has surprised to the upside. But you'd have to make that call for 10 years. It's much harder than just thinking, oh, inflation is going to be high, I should own a tip.
Right. So last question here. How does this, if you throw that chart back up, how does this current situation impact the Fed as it stands today and their ability to raise rates? Is this going to do it for them, or do they still have to aggressively raise rates to slow the economy?
So how the Fed would be thinking about this situation is borrowing costs are extremely low, and inflationary pressures don't seem to be putting a tremendous amount of upward pressure on yields. So they don't necessarily have to aggressively hike short-term rates to keep long-term rates from going up too rapidly, or to keep inflation from rising too rapidly, like they did in past cycles. So for example, you go back to the 80s. Well, the Fed at that point, Paul Volcker, was raising short-term interest rates in excess of 20% to try to fight inflation. So then we could have a 40-year period of downward sloping inflation and downward sloping bond yields. The Fed now is in a much different situation. There isn't 10-15% bond yields right now. They're just not going to happen. And so they don't need to be super aggressive in fighting inflation at this point.